Let's say that we started a high-end tech consulting firm on January 1st. By the end of the month, our income statement looks great. We've had 4 transactions, and when we put together the income statement, it looks like we're making a lot of money. Let's walk through the scenario and see how the income statement looks. So first of all, we created a massive project and sent an invoice for $150,000. Under accrual accounting, we record the revenue when it is earned, when the work is done, not necessarily when we receive the cash. So we don't really care that the client hasn't paid us yet, so we haven't received the check, but we did the work for $150,000. So we have revenue of $150,000 in January. All right, let's move on to the second one. We prepaid our rent, $24,000. Again, under accrual basis accounting, it doesn't matter when we paid it, the expense happens when we use it. So the question is, how much of the service did we use in January? And we used $2,000. So we'll subtract our rent of $2,000, even though we paid $24,000 for it. We also bought $30,000 worth of equipment, but we didn't use it all up at the same time. With equipment, we would record depreciation, and we put an estimated life of 5 years with no salvage value. So we just go with $30,000 divided by 5 years is $6,000, but we're also doing this monthly, so let's divide that by 12 to get $500 of depreciation. And this last one, we have an assistant and we owe them $4,000. We haven't paid them yet, but again, under accrual basis accounting, the cash doesn't matter. It's when did we use the service. And we used the service in January, so we actually do have a $4,000 expense. So what our income statement is showing us is we are very profitable. I think we end up with $143,500, if I did my math right here, in net income. That's not bad for our first month in business. So we take out our team, our assistant, and whoever else is on the team to celebrate at the local restaurant, and we try to pay for the dinner, and our business credit card is declined. Now, why is it declined? We're doing so well. We're so profitable. Well, the problem is that accrual basis accounting and looking at the income statement, it does not measure the amount of cash that we have. So let's look at how much cash we actually have in our business. Well, we haven't gotten this $150,000. So that is still in the future. So no cash there. We paid $24,000 for the rent. So that's a cash outflow. Even though we only have $2,000 of expense, but if we're looking at our cash, we spent $24,000 in cash. Our depreciation expense is $500, but that also does not reflect the amount of cash that we have. We paid $30,000 for that. And at the wages, even though we have a $4,000 expense, we didn't actually pay any of that yet, so we can ignore that one. We end up with $54,000 in the hole right now, which is why our credit card is declined. Even though on paper we're looking pretty profitable with $143,500, we could still run into problems in our business because we're not paying attention to our cash. We have to have both to be successful as a business. We have to pay attention to our net income and our cash flow to survive. So we can't just look at our net income and say, oh, we're doing great, or look at our cash flows and say, we are doing great as well. So let's say we got $150,000 in cash. That does not necessarily mean that we're doing well. We have to take both of them. Beginning of the semester, we talked about 3 of the financial statements: income statement, statement of owner's equity, and the balance sheet. None of those help us measure our cash. And so people may have looked at this and said, hey, all of this information is important, but you know what else is important? Where our cash is coming from and where it's going. Let's make another statement that helps us measure that. And that is where we get the statement of cash flows. We did not cover that earlier in the semester because it is the most complicated financial statement that we are covering. And we needed a little bit more knowledge and information to be able to understand how to put this together. We're now at the point where we should have all of the knowledge and skills necessary to do this last financial statement. So that's what we're going to be covering this chapter, is how do we put together the statement of cash flows and how do we read it?